It is Friday evening, 6:15. Your bank just sent you a notification, but it is not about your balance. It is about the fact that your bank no longer exists. Somewhere in Washington, a team of federal agents already knew this was coming. They have been inside the building since noon. Their lanyards are from a bank that closed 3 years ago. No one asks questions. Right now, they are changing the locks. And your $50,000 is sitting in a system that just lost its owner. Your money is not gone. It is in limbo, right here on How Things Count. We are going inside the secret weekend operation that gets it back. The first thing to understand is that bank failures do not happen by accident. They happen on Fridays, almost always after the close of business. This is deliberate. The FDIC needs the weekend. 48 hours to dismantle one bank and rebuild it as another before you walk in Monday morning expecting everything to work. But the real process started weeks earlier. The moment the government realized your bank was running out of money, the FDIC began running a secret auction. They packaged your bank's books. Every loan, every deposit, every branch lease. They sent that package to a short list of healthy banks and said, "Make us an offer." Those bids came back sealed. The winning bank was chosen before your bank even closed. You just did not know it yet. So what happens to your $50,000 between Friday night and Monday morning? The answer depends on one decision. Did another bank agree to buy yours? In 90% of failures, the answer is yes. Think of it like an apartment building changing landlords overnight. Your lease, your furniture, your keys, all the same. The name on the mailbox is different, but nothing inside your unit changed. The industry calls this a purchase and assumption. The acquiring bank takes on certain assets and assumes all insured deposits. Your money does not move. The database record pointing to your account gets a new owner. Monday morning, the doors open. There might be a new sign out front, but your balance reads $50,000, your debit card works, and your direct deposit still lands on the 15th. Checks you wrote last week still clear. The FDIC's goal is to make the entire transition invisible to you. But where does the money come from? Who actually guarantees your $50,000? Not the government, not taxpayers. The answer is the Deposit Insurance Fund. Every FDIC-insured bank in America pays a quarterly premium into this fund. Think of it like a communal insurance pool. 4,000 banks pay premiums into one pot. When one fails, depositors are paid from what the survivors contributed. That fund currently holds over $128 billion. Before you think that is just a number on a screen, consider this. More than 4,000 banks have failed since 1933, and not a single insured depositor has ever lost a penny. Not one, in 91 years. That is not a marketing claim. That is the longest unbroken guarantee in American finance. So the system is designed to be invisible. But what happens when no bank wants to buy yours? That is when things get uncomfortable. This is called a deposit payoff. No acquirer steps in. Instead, the FDIC calculates your insured balance, principal plus any interest accrued through Friday evening. Then they mail you a check. Typically within 2 business days, you deposit that check at a new bank of your choosing and move on. But this creates a gap. For those 2 days, your money is not accessible through any ATM or app. Your automatic payments will bounce. Your payroll might not land. The system works, but it does not feel invisible the way a purchase and assumption does. But there is a harder question. The FDIC insures $250,000 per depositor, per bank, per ownership category. If your checking account held $300,000, the first $250,000 comes back fast. The remaining $50,000 sits in a different line. You get something called a receivership certificate, a claim against whatever the FDIC recovers by selling the failed bank's assets. Historically, uninsured depositors recover 60 to 80 cents on the dollar, but it can take months, sometimes years. Silicon Valley Bank collapsed in March 2023. Depositors pulled $42 billion in a single day. 85% of its deposits were uninsured. The Treasury had to invoke a systemic risk exception to cover everyone. That exception is not automatic. It required a joint decision by the Treasury Secretary, the Fed Chair, and 2/3 of the FDIC board. Your $50,000? You never needed that exception. You were always covered. But the person sitting in that same bank with $2 million in a business operating account was not. So here's the full picture. Your bank fails on a Friday. A pre-selected acquirer takes over by Monday. Your balance stays the same. Your debit card works. The fund that pays for this has been built by bank premiums for 9 decades and has never failed a single insured depositor. The system is not glamorous. There is no dramatic rescue. Just a quiet weekend operation that moves ownership of a database, changes a sign, and opens the doors like nothing happened. And the reason it works is that the FDIC was already finished before most people even heard the news.